Hi, I'm Doug McDonald-Korth, editor of the Oxford World Financial Digest, OxWFD. This video is part of our new weekly recap series where we cover the top stories of the week and then give OxWFD's insights and opinion on them. Equity markets all over the world had a relatively quiet week, at least as compared to the huge volatility of late, save for Japan. Chinese equity markets had a much calmer week than investors have grown accustomed to, and saw little overall change during the week. European stocks were also mostly flat. Japanese equity markets were the big mover, as the Nikkei saw a 7.7% rally on a single day last week, on hopes that worries over China were overblown. US equity markets were broadly flat, ending the week on an upbeat note on Friday. However, all eyes are now on the Fed, which we'll come back to in a minute. Oil markets also saw a tight trading range over the week. There were numerous headlines arguing every conceivable position on oil, but perhaps the most prominent of which was Goldman arguing that the commodity could fall to $20 a barrel if production was not cut. This coming week will be all about the Fed, as the U.S.'s central bank will be holding one of its most highly anticipated meetings in years this week. Markets are currently placing a 28% chance that the bank hikes rates. Fed officials have entered their silent period ahead of the meeting, but numerous public comments prior to this indicated that there was a large divergence between many officials, perhaps lowering expectations for a Fed move. U.S. import prices fell sharply this month, which added to worries about slowing inflation and possible deflation. So what do we think of all this? Firstly, on oil, we still maintain the position that the market will continue to be oversupplied and that demand is going nowhere. Therefore, we think there will continue to be downward pressure to the commodity. Citigroup pointed out that it believes lenders will cut back capital flows to the U.S. oil sector, which could crimp production by 500,000 barrels per day, which is something to look out for. Now on to the Fed and markets. We do not think the Fed should hike interest rates. Growth is not stellar, there are a host of overseas risks, and a stronger dollar would hurt exports and commodity prices, the latter of which would pull down an already anemic inflation rate. The only upside to the economy is the jobs report, but that is not nearly enough to warrant a hike, especially considering some asset prices, like equities, have already fallen, and credit markets have gotten tighter. Despite how long it has been broadcast, we think equity markets could react sharply if the Fed does decide to hike this week, as could credit markets. Thanks so much for joining us, and make sure to join us next week.